Well, hello, everyone, and thank you so much for coming today to the Benjamin Z. Miller Investor Networking Group. We have a really exciting topic that we'll be talking about today that a lot of people are not so familiar with. It's a niche topic within the broad category of real estate investing. So what we're going to talk about today is how you can make money as a landlord, not for a small house with one tenant or a small apartment or flat for one tenant, but where you have a company like McDonald's as your tenant, or you have a company like a big drug pharmacy company like Walgreens or CVS. The examples that I'm going to show here today are mostly from the United States. But what we will look at here today, it applies to Germany, it applies to any country that is out there. You'll find this type of real estate investing. There might be very, very small differences, but if you understand the ideas here in your local market, whether you're in Canada or you're in Sweden or you're in Ukraine, you will see that commercial companies lease these office spaces, and you can profit if you know how to work in this space. So very good. So what is net lease? It's called net lease investing, and it's typically, there's three categories. There's what's called single net, and that's just one letter in. There's double net, which is two letters in, and then there's triple net, which is three letters in. And basically these denote the landlord responsibility. So if you are a landlord, imagine you buy some flats. You have a flat that you buy, an apartment that you buy, and you lease it to a tenant. Well, when something breaks down, you have to fix it for your tenant. You can't say to the tenant very effectively, look, there's a plumbing problem. I'm not going to fix it. It's your problem. You have to go and get a plumber and fix it. But with net lease, it is not that way at all. With net lease, you can put those responsibilities onto the tenant. And in fact, larger companies, they want to take those responsibilities because they want their stores, their workspaces to look uniform. That is very important to them for their brand and for their corporate image. So with a net lease investment, you would have what's called a single net lease, and that means that you have one tenant that rents one building. So in this picture here, we see in the United States this big company called Walgreens. It's a little hard to read on the side of the building there, but it says Walgreens. That's a big company, a big drugstore in the United States. And they rent big buildings. They don't own the buildings. They pay rent to a landlord. And if you know how to do these deals, you can actually purchase these buildings and lease them to large tenants. So a single tenant net lease requires the tenant to pay the property taxes in addition to the rent. Normally, if you are a landlord and you own a flat or an apartment, you have to pay the taxes. You can't tell your tenant, hey, you need to pay the taxes. No, that's not normal for residential. But if you're in the commercial world, it's absolutely normal. It's something that happens all the time. And the more ends that you get, if you move from a single net to a double net to a triple net, the better it is for you as a landlord, because we'll go through on the next slide the difference in those. But if we look at the tenant responsibilities, first of all, not shown on this chart is the common residential lease, which is, like a gross lease. It's something like that, where you're potentially taking on more responsibilities as a landlord. But if you execute a single tenant lease, if you execute a single tenant net lease, the tenant has to pay the property taxes in addition to the rent. If you execute a double net lease, the tenant has to pay the rent. They also have to pay the property taxes, and they also have to pay the insurance. Now that sounds pretty good if you can get your tenant to pay all of that. If you get a triple net, the tenant has to pay for the taxes. They have to pay for the insurance. The tenant also has to fix things on the property. So these are even better. And then the gold standard, the one that is the best for the landlord, is if you can get what's called an absolute triple net or a bond lease, or it's sometimes called a hell or high water lease. This is a lease that puts 100% of everything on the tenant's back. So if the building burns down and you have an absolute triple net lease, it's not even your problem as a landlord. You can say, look, we have an agreement. I'm sorry that the building burned down, but we have a bond lease. We have a hell or high water lease. I need you to rebuild the building. I need you to keep making payments to me. So that's that's quite a situation there. Now let's look at some a graphic here that shows triple net cap rate. Cap rate is basically the income. I'm going to come back to this slide here, but I want to show this first. Let's look at what cap rate is. Cap rate is the net operating income, which you can see right there, divided by the price of the property. So what you will find is that if you take a property that earns, for example, $50,000 or $100,000 a year, let's say that the price of the property is 1 million. Well, to determine the cap rate, you would divide. If it generates 50,000 in net operating income and the price of the building is 1 million, the cap rate is 0.05, and that's called a 5 cap. They don't say it's 0.05, they say it's a 5 cap. Or if the income is higher, say that it's 100,000 and the price is 1 million, that is a 10 cap. But when you divide it out, you get 0.10. But when people are speaking about it in conversation, they say it's a 10 cap. We'll talk about these cap rates on a different slide, but in general, the higher the cap rate, the more risk. The lower the cap rate, assuming that it's priced correctly by the market, where it's not a seller giving you the cap rate, but it's something that's determined by market forces, the lower the cap rate, the lower the risk. And we'll go through that in a minute, but I want to go back to this slide. Now, if we look at this chart, we see triple net lease yields. So triple net cap rate is the one that's on top. So that we see this line on top, triple net cap rate. This would be like if the building cost $1 million and it had 64,000 in operating income, it would have a 6.4% cap rate. And then if we were to go in this direction, what happens is the cap rate is increasing. Now let's compare that to bonds, because basically with bonds, bonds are categorized by what are called investment grade bonds. And an investment grade bond is one that is of a company that has a rating, a public company that has a rating by an independent rating agency like Moody's or Standard & Poor's or Fitch. These are rating agencies. And the point is, you'll notice that the rates are even lower here. So you're only going to get 2%. So if you put $1 million into an investment grade bond that has a yield of 2%, you're only going to get 20,000 of income off of it. Whereas if you put $1 million into a triple net cap rate, you would get 6.4%. So the point is, these triple net deals offer some advantages that you don't find in a bond. They are often treated like a bond, and they have similar characteristics to a bond, but they're a little bit different than a bond. The first difference is with real estate, net lease gives you a tax benefit that is called depreciation. So if you're in business and you have a lot of income and the government says, well, you know, you've got a lot of income, you need to pay a lot of taxes. You can say, well, I do have a lot of income, but I have a lot of net lease real estate. So I am entitled, according to your laws, to take a deduction to make my taxes lower so I can reduce my taxes. You don't get that benefit if you buy a bond. You do get that benefit if you buy triple net real estate. The second thing is there's the potential. It's not a certainty, but the potential exists that if you put $1 million into a triple net real estate deal, potentially in 10 or 15 years, it could happen where that building is no longer worth $1 million, it's worth $2 million. It also could be worth less, but the potential exists for capital appreciation. You'd never have that with an investment grade bond, because you're going to put $1 million in on an investment grade bond. You're going to get about a 2% rate of return. You're going to get $20,000 a year in income for 10 or 15 years. Then you're going to get your $1 million back, but you're only going to get that. Whereas with triple net, you could get 6%, for example. And then at the end of it, you could get maybe even more than $1 million back, depending on what happened with the lease. So now, why would companies actually do this? This is kind of an interesting question, because a lot of these powerful companies like Starbucks or McDonald's, they have lots of money. They don't need a landlord. I mean, they could just go buy the building themselves. Why in the world would they do that? Well, the reason they do that is these companies have a philosophy in business that they have a core business. And that core business, for example, with Starbucks, is they say, in the coffee business, we can get a 40%, maybe even a 50% rate of return on capital. But if we were to go into the real estate business and buy the buildings, we might only get an 8% rate of return on capital. We're not interested in 8%. We want to get a 50 or a 60% or a 40% rate of return. So that is why these big companies, even though they have lots of money, and even though it would benefit them in some ways to buy these things, they focus on their core business. And that creates an opportunity for the investor like yourself that likes the idea of having your tenant be McDonald's. You like the idea of Starbucks owes you money and is going to pay you money every month. So these are the opportunities. Now, we talked about cap rate. We went through the calculation of it. It's basically just the net operating income by the price of the property. But here's what I want you to take away from this. Low quality, bad assets, they have high cap rates. So, in the United States, we have areas that are dangerous areas. We have areas that maybe are a ghetto, where there's dangerous areas, where there's drive-by shootings. You could go buy a package of 20 rental homes in one of these bad areas. Maybe each of these rental homes would cost $20 or $30 or $40,000. You could buy a package of them. And the cap rate on those rental homes on paper, it would show that you're going to get a 15 cap rate, which is a very high cap rate. Because a high quality asset would have a lower cap rate. But a lot of beginning investors, they chase high cap rates. They're like a dog that just chases a high cap rate, and they don't understand that that's not a good way to invest, chasing a high cap rate, because their thought process is, I want money. If I can get a higher cap rate, that's better. That's what I want. But they forget in their excitement that buying a package of 20 homes in the ghetto that has a 15 cap rate, it can put you as a landlord in danger, because you may get shot trying to collect the rent. If you have a property manager do it, they may get shot. So you have to factor that in. So a lower cap rate where you're getting less operating income actually is a safer investment. But this is also caused by landlords mispricing their assets. This is something that is important to understand. I'm going to show here an example of a high quality tenant. We all know that McDonald's is a very, very high quality tenant. McDonald's has a lot of money, and they earn a lot of money. And if McDonald's signs a contract with you, there's a very high probability they're going to honor that contract. Unlike a plumber who just is a new businessman that's got a business doing plumbing, he'll honor that contract unless he has a problem. If he gets on drugs, he'll stop honoring the contract. But if you're dealing with a corporate entity like McDonald's, you've got a high quality tenant, and you will see a low cap rate. Notice that this is a 3.85% cap rate. So this particular asset, it's a real asset. It's in Florida, and it costs $1.659 million. That's the price of this asset. But notice that the cap rate is 3.85%. So the income, if you wanted to know, hey, how much money am I going to get if I buy this asset? Well, that asset's going to cost you $1.659 million. and you're going to get a 3.85% cap rate. So you can calculate how much rental income you're going to get. 63,872 in annual rent. That is fantastic. So you would get that as annual, but it's paid monthly. It's normally paid monthly. So you get monthly payments of about 5,300. Now let's take a look at a bad quality asset. Look at this. This has a 25% cap rate. Well, that's amazing. That's like 25%. Why would I want 3% when I could have 25%? I'm going to get more money. I mean, this asset costs $800,000. The cap rate is 25%. So the income that property generates is 800,000 multiplied by 0.25. This is advertising that if you buy this asset for 800,000, you will receive 200,000 in annual rent. Well, that's incredible. That's an amazing result. That is an amazing result to get that. I mean, that sounds too good to be true. I wonder if it is too good to be true. Well, in this instance here, let's think about this. We don't have McDonald's. We've got a tenant that is a fireworks stand. It looks like this building is a place where they sell fireworks. And the person that owns the building, I am guessing, I am almost 100% sure, I don't know this for a fact, it's just experience. I bet you that the owner of that building is the one that's selling the building to us, where he has a firework company and he's saying, look, I've got this great firework company. I want to sell my building, but I want to keep renting it. Just pay me 800,000 and then I'll pay you 200,000 a year. And that sounds very tempting. But what if you buy that building and then the owner says, you know what? The fireworks business is not going well. You know, he makes a payment for a month or two and then he has a business problem and he says, it's not working. I'm going to have to shut it down. I'm sorry about that. Well, he just got 800,000 when that building sold. And you were expecting to get monthly, you were expecting to get annual rent of 200,000. You were expecting monthly payments of 16,667. But in fact, you may only collect one or two payments. And then he may go out of business. So the point is, all that glitters is not gold. And that is so, so important when you are doing this sort of an investment. Now let's take the example of how does the value of an asset change? Because this is so different than the residential world. In the residential real estate world, an asset is determined by a comparable sales approach. So if you have a house or you have a flat or you have an apartment, you can tell how much that will sell for based on what are the other houses and flats selling for, because that's the market value. It's so much per square foot or per square meter. If you're in Europe, it's so much. So this is what happens. So let's imagine that we have an empty building with no tenant. We can see this on the left. Imagine you're driving around in your city and you see an empty building with no tenant. If there's no tenant, there's no lease. So the only way you can value that is based on comparing it to what did the other empty buildings sell for. So you would get a list of empty buildings in that city and you'd talk to real estate people, but you'd put together a few comparable sales and you would determine, oh, it's worth 400,000. Okay. So if you buy it for 400,000, you have no rental income. So what are you going to do with it? I don't know. You're going to hope you find a tenant. Now let's imagine that what happens is you get lucky. You buy it for 400,000 and all of a sudden, out of nowhere, a plumber appears. This plumber has a business that has been around for about 10 years fixing plumbing, and he's got trucks and he's got 10 workers. He has 10 workers in his business and he needs that building and he wants to put a sign up that says Joe's Plumbing, and he's thinking this is going to be great. And he says, you know what? I'll pay you $10,000 a month. Let me rent your building. And you're thinking, yeah, that sounds good. Why don't you do that, Joe? So you sign a lease with Joe. The minute that you sign that lease with Joe, all of a sudden it's no longer a vacant building. The value of the building has changed. That building is now worth potentially $800,000 because of the fact that Joe Plumber signed a lease. Now, The weaker the tenant, the less the value moves. So for example, if you found some homeless person that said they'd pay you $10,000 a month and they signed a lease, that's not going to change the value because they're not going to have any money in the deal. There's not going to be anything there. But if you found a legitimate, what's called a non-credit tenant, that's not a high quality tenant, but not a terrible one. You know, Joe's Plumbing, that could double the value. Now imagine that instead of that, you rolled the dice and you got lucky. You got lucky in a big way, where instead of Joe, you got a phone call from somebody from some company called Dollar General. And if you look on the right, you can see a picture of Dollar General. Dollar General, they send over their real estate agent and they explain, you know, we'd like this for a store location and we want to make an offer to lease it. And you say, great, what's your offer? And Dollar General says, I'll pay you $10,000 a month for 15 years. And you say, okay, that sounds good. I'll take it. But now look at what happened. Now that building has gone from 400,000 to 1.6 million. And the reason it has increased so much is the quality of the tenant. You've got a home run tenant. You've got a high quality tenant. You've got a tenant that is going to pay. That tenant, Dollar General, is not going to get on drugs. That tenant is not going to get a divorce. That tenant is going to pay on time. So you've got a corporate guarantee. Unlike Joe's Plumbing, it's still great because Joe's going to pay you $10,000 a month. But if Joe gets a divorce, if he gets on drugs, that's going to stop. If his business fails, that's going to stop. But not with Dollar General. With Dollar General, they have thousands of stores, thousands of locations, so that when they sign an agreement, that has a lot of meaning, and that will take a value from 400,000 to 1.6 million. That is the beauty of it. That is a huge thing that very few people really understand, how much a vacant building can change based on the quality of the tenant. But if you line things up, you can have some great results with that. So now, why net lease? Well, it's one of the most reliable forms of rental income. This is where the more experienced investors end up. The newer investors, they're excited about, hey, you know, I've got some houses, I've got some flats. But after doing that for a few years, you find out, you know what, I really would like to just get the money and get paid on time. I don't want to hear about the toilet. I don't want to hear about the plumbing problem. I just want the money. And that's why you end up in net lease. Net lease is more attractive. Nothing wrong with residential. Residential's fine to practice while you're learning, but net lease is where it's easier. You're dealing with businesses. There's often no responsibilities. You're not going to have to hear a phone call about why the toilet's not working. It's not going to come up. You're not going to have to pay the taxes and the insurance if you negotiate it right. So let's take a look at an actual deal. This is a deal that was in Texas, and I'll just show this as an example here.
When you purchase a net lease property, the normal way this begins is you submit what's called a letter of intent. And here is an example of a letter of intent. This was on a Dollar General that was located in Abilene, Texas. The price of it was $1.695 million, and earnest money was $10,000. And there was a 45-day inspection period, financing to be determined, and then it had some other things with the transaction costs. But this is how the process starts. This is before you have an actual contract. This is called a non-binding letter of intent to purchase. And it's what your first step towards purchasing net lease property. So I'm going to show an example of what this looks like. There's a company in the United States that's called Dollar General, and they actually have a lot of stores. They've got thousands of stores. It's a big corporation. And this was a deal that was in Abilene, Texas. And the seller, I was buying property in Abilene, Texas. The seller was Dollar General. And it was located at 4325 10th Street. The price on it was 1.695 million. There was an earnest money deposit of 10,000. There was a real estate commission, and then title policy, recording charges, some legal fees. And basically this was the total on it. This particular property had a price, all in, all the fees, everything, of about 1.73 million, 1.74 million. And, it was it was in Texas. Now, there was a lease that went along with this, and I'll show that lease here. Okay, so I'm going to show an example here of a lease. A lease is a contract to rent real estate. So this is a lease between Dollar General Corporation. They are the tenant. Dollar General is going to operate a store and then pay rent to the landlord. And the document I'm going to show you is a real document that's for a net lease property. So this basically, it has, here it says lease, and then you've got the limited liability company. You've got the effective date of the lease. You've got the name of the current landlord. This was actually the builder. So the builder was building Dollar Generals and then selling the Dollar General. And then here's what they look like. It's, it's an extensive lease. And basically it has a lot of information in it where you can kind of look through, see what's the delivery date. The building is supposed to be completed in 150 days. Information on the tenants, what the tenant is going to be doing. The term of the lease is 15. You can see here where it says 15 consecutive full years. So it's a 15-year lease. It has the option to extend. And then here's the rent. So the rent is going to be $8,315 per month. And then if the lease is renewed, if the company wants the space longer, they have to pay higher rent. Then they have to pay $9,147 per month. And if they renew yet again, it can go up to $10,000 and then up to $11,000. Says that it has basically all of the details here. So that kind of gives you an idea of what one of those leases look like. This lease, just to kind of scroll to it, it's quite a document. It's about 60 pages. But it has all sorts of information in there, and it really kind of gives you an idea of what one of these looks like.
So that's just an example so that you have kind of an idea of what these look like. Now let's talk about, are these deals syndicated? So syndication is where you have a group of investors that are organizing money together. And these are actually popular as syndicated deals, because let's imagine that the asset costs $2 million. Let's say that the financing that is available, perhaps through a bank or through some other institution, is 70% of the value. So you can obtain 70% of 2 million. You can obtain 1.4 million using commercial debt. But in order to get that 1.4 million, the lender is going to say, we'll loan you the 1.4 million, but we want you to invest 600,000 so we feel safe. So we know that you've got something in the deal. So then that 600,000, you would organize that with multiple investors. Maybe you would get each investor to put in 100,000, 200,000, 50,000. You'd add it together, where if you're the syndicator, if you're the one that is putting the deal together, that has the knowledge, you may get 20%, maybe even 50% free ownership. But the partners that are putting in the money, they are getting a lot of the ownership. They're getting a lot of the ownership. But this is something that is kind of negotiated deal to deal, and there's some flexibility, but you're trying to find a combination that works. What sort of investors like net lease? Well, the investors that are attracted to this are older investors where they cannot take risks anymore. So older people that they need a very safe investment. It's a lot safer being the landlord for McDonald's or for Dollar General than it is to be the landlord of, 3 or 4 or 5 flats. So this is something that appeals to investors that they are no longer concerned with, I've got to double my money as fast as possible. Younger investors, that's all they want. They want to double their money, triple it. They want to get a big return. But older investors, they are more afraid of losing the money. So this is what is appealing there. Another segment is, in addition to investors that are looking for reliable passive income and they'll accept lower rates of return, are institutional investors. Institutional investors could be a big pension fund, a big insurance company. These sorts of investors, they are looking around and they are always interested in places where they can obtain what are called trophy assets. They like to have trophy assets. So big companies like this, they're fine with having some McDonald's, they're fine with having some Dollar General, but they also like really high quality assets that are, right downtown, the nicest, most prestigious assets, and they'll accept incredibly low rates of return, 2 or 3% per year, because to them, they know that over time, the values are going to go higher over decades. So they're okay with placing money and waiting 10 years or 15 years. Unlike a normal investor that's trying to turn around and get the money back after 3, 4, 5 years. So these are kind of where it appeals. And that is it for my presentation. So I'm going to stop the recording now, and then I'll be very happy to answer any questions that anyone may have about this presentation or other questions. And I also would like to remind you to please, in the chat window, if you want to, I encourage you to fill in your information so that we can get you a copy of this presentation and some other things. And also so that when we have other investors that come later, they may see your information and think, hey, I need to reach out to that contact. So it's a way of getting some more benefits for yourself. So okay, very good. I'm going to stop the recording and then I'll be happy to answer any questions.